fast switch. If you look at, it's like being a highly paid.
Acts like this flawless trap.
If you're a company spending billions on these ultra expensive AI, any choice but to pay up for the top tier gear.
You really don't.
Territory.
Oh, absolutely.
That is just unheard of for a business.
Their profitability.
Right.
Because in the fourth quarter, they're operating.
3 reasons why you should buy this stock and 1 reason why you should avoid it at all cost. Stay until the end of the video to know more.
Today's deep dive breaks down Arista Networks. We are exploring 3 reasons why you should buy the stock and finally 1 reason why you should avoid it at all cost. So to really grasp this company, you just have to imagine a toll booth.
Right, like a toll booth on the only highway leading to the AI gold rush.
Exactly.
Okay.
Every single time data moves, they take a cut. And I mean, last year, that little toll booth raked in just over $9 billion in revenue.
Yeah, $9.006 billion for fiscal year 2025, to be exact, which that's a massive 28.6% jump year over year.
Which is wild.
It really is. But, you know, anyone can grow revenue by just throwing cash at a wall. The first real reason to buy is that financial momentum, specifically their profitability.
Right.
Because in the fourth quarter, their operating margins hit 47.5%.
I mean, 47.5% is basically software company territory.
Oh, absolutely.
That is just unheard of for a business selling physical hardware.
Totally unheard of.
That kind of high margin operating leverage means that once their base costs are covered, almost every new dollar you bring in just drops straight to the bottom line.
Exactly.
But I guess a lot of that stems from their software-first approach to networking, right?
Yeah.
Because with an earnings per share growth rate over 20%, they are trading at this massive premium.
Yeah, a huge premium.
So the question is, does a hardware company actually deserve that kind of multiple?
Well, I'd argue it does when the hardware is like completely irreplicable. To understand those margins, you really have to look past the financial spreadsheets and examine the actual tech they're building.
Which leads us to reason number 2.
The industry-leading AI products.
Right.
Specifically, the new R4 series switches. So standard internet traffic, it comes in these bursts. You load a web page, and then you just wait.
Right, it's not constant.
Exactly. But AI training is a whole different beast. It requires thousands of GPUs talking to each other simultaneously, literally 24/7.
And you can't drop a single packet of data.
Not one. The R4 switch acts like this flawless traffic cop for that massive flow of data.
Which is exactly why Meta is deploying the 77,000 R4 in their newest AI clusters.
Exactly. And the independent analysts are seeing this too. Like Gartner recently ranked Arista as the ultimate leader in execution for data center switching.
Oh, wow, the ultimate leader. Okay, well, that makes complete sense because, I mean, if your network blinks during AI training, the whole billion-dollar system basically crashes.
Catastrophic, yeah.
But here's what I find super fascinating about this. They aren't just selling, one incredibly fast switch. If you look at their 2025 acquisition of VelaCloud.
Oh, right, the VelaCloud deal.
Yeah. They are building this really sticky, one-stop ecosystem. So once a company integrates Arista's software and hardware across their entire enterprise network, trying to rip it out to use a competitor is just a complete logistical nightmare.
It's impossible. They are basically embedding themselves as the central nervous system of the enterprise. And companies are aggressively buying into this ecosystem, not even for like marginal IT upgrades, but honestly out of sheer panic.
Which transitions us perfectly to the third reason, right? The massive cloud and AI demand tailwinds.
Exactly. Gartner actually issued this really stark warning recently. They said running modern AI workloads on legacy networking gear wastes at least 30% of your processing capability.
Wait, 30%?
Yeah, almost a third of your power just gone.
Yeah.
So you literally cannot afford to use old switches.
I mean, if you're a company spending billions on these ultra-expensive AI chips, you'd be insane to throttle them with a cheap network switch.
Right, it makes no sense.
It's essentially an AI survival tax.
Yeah.
And if you want to actually compete in the AI race, do you really have any choice but to pay up for the top-tier gear?
You really don't. And because of this frantic need to upgrade, analysts actually believe Arista's 2026 guidance, which, by the way, predicts 25% growth, is highly conservative.
Wow.
Yeah. Bandwidth demands really only go in one direction, and that's up. But this is exactly where we need to pivot. Because the massive scale of this demand also exposes Arista's biggest vulnerability.
The buyers themselves.
Exactly. The very specific profile of the companies actually writing those huge checks.
And this brings us to the reason you should avoid the stock at all cost. intense customer and geopolitical risk.
Yeah, this is the massive red flag. A huge portion of Arista's revenue comes from just a tiny handful of clients. I mean, Microsoft alone drives about 20% of their sales.
That is wild.
And Meta has previously accounted for around 26%. Plus, if you look at their own filings, escalating U.S.-China tariffs could instantly disrupt their component supply chains.
Which would just immediately compress those beautiful 47.5% margins we talked about.
Instantly. And that is a highly dangerous setup when your stock is trading at a lofty 51 times price-to-earnings ratio.
Yeah, it's like being a highly paid private chef, but you only have 2 clients.
Right.
If Microsoft or Meta suddenly decide to go on a diet, your kitchen just goes bankrupt overnight.
That is a perfect way to look at it.
Let me push back on that just a little bit, though. Say just one of these hyperscalers, these massive tech giants, say they decide to trim their switch orders by just 10%. How bad is the damage, really?
Honestly, it's severe. You remember that incredible operating leverage we were praising earlier?
Yeah, where every new dollar is pure profit.
Right. Well, it cuts both ways. So a small 10% drop in revenue disproportionately slashes their profits.
Oh, I see.
Yeah, that kind of cut could easily wipe out the rapid earnings growth that's actually justifying their high valuation right now.
And then the stock price would likely collapse.
Exactly.
So you're basically paying an absolute premium for a company with incredible tech and margins, but the entire foundation relies on just a couple of massive tech giants continually footing the bill.
That is the risk in a nutshell.
Well, it really leaves you with this to ponder. If these hyperscalers eventually get tired of paying that AI survival tax, and they decide to just build their own in-house Ethernet networking solutions to cut costs, what is the end game for the hardware vendors that pave their way?
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!